level. Clifford Bennett joining us from ACY Securities. Clifford, good to see you.
Good morning, Andrew.
All right. What did you make of those flash PMIs? You know, we're seeing that, deterioration in services and manufacturing, not just the US, but also obviously in Europe and the UK.
Yes, and very poor data in Australia yesterday as well, using the same providers. So that US data really just emphasizes that when we're looking at the stock market and our investment portfolio, it's a lot more than just Fed interest rates. We had that good rally when the Wall Street Journal put out an article saying that the Fed will pause or slow rate hikes sooner than expected. And markets reacted to that in a very binary fashion. But if there is any pause in the Fed hiking interest rates, it will only be because they are finally recognizing the US economy is actually in a lot of trouble. And that data yesterday confirms that. The private sector, Main Street, Wall Street, if you like, they're behind the curve. So Wall Street thinking is behind the curve of what is actually happening in Main Street, USA. And there's going to be a catch up there. And that's why a lot of the big funds this year have got it wrong. We're caught really leveraged long at the top and are still unwinding. But we are seeing some congestion in equity markets at the moment to sort of work out where to from here. So we are getting some spikes, but that data really does emphasize that not as all well in the US economy. We're seeing property prices start to fall now. We're seeing a lot of the indicators that we had before the GFC, but this one could be bigger in terms of a recession for the United States. Already in recession, does it go into depression next year? And that's not a healthy global outlook for Australia either.
So what do you make of that recent rally in equity markets then?
Oh, it's very impressive, but
well, yes,
but they're always impressive, but they only come back to where they were 2 days ago in the downside. So we have equally impressive down moves, then we have these big impressive up moves, and people get all excited about the 2-day rally or the 3-day rally. Usually they last 5 to 7 days, maybe 9 during this year. That's been the pattern. But also, I think this one's already starting to tire. People got excited about the idea bad economic data means the Fed won't hike as much, but that's thinking. It's a simplistic thinking that the stock market only reacts to what interest rates do. When in reality, if you step back at a macro level, what really is going on in the long term, not necessarily in the short-term sentiment, but in the long term is that interest rates and the stock market are always both reacting to the same stimuli, which is the health of the US economy. And what we've had recently is the US economy is diving, and the Fed is hiking interest rates because it got inflation wrong 12 months ago, saying it was transitory and nothing to worry about. Now it's chasing it, just as we forecast they would be doing. Similar story in Australia, but RBA is starting to slow down. But this is an unusual historic situation where the economy has been slowing as the Federal Reserve is raising interest rates aggressively. That's never happened before, and that's going to cause an even deeper clunk, if you like, to the US economy, to Main Street USA, which Wall Street hasn't really fathomed yet and will be playing catch up. So whilst we'll see good rallies from time to time, I think there's a lot of hedge funds and big super fund style organizations out there that still need to unwind their portfolios. And even if they don't want to, actually, redemptions are starting to go through the roof now from their investors. I think BlackRock's gone through a tremendous drawdown on its funds under management, so they're forced to sell regardless of their view. So I think it's a nice rally. It could have more to run, but I think there's further, at least sideways congestion. The best I can see for the US stock market at the moment is we churn volatile sideways for 3 to 6 months. And that sort of thing has happened before, but that's the most bullish I can get on the US stock market at this point.
All right, well, let's focus on what's going on locally then. And of course, tonight, federal budget, first one from the new government. What should they be doing, do you think?
Well, yeah. It's interesting, isn't it? Because it's a Labor government and they're winding back infrastructure spending by the sounds of things. But we'll have to see what the detail is going forward. But they're focusing on the fiscal bottom line, which is a good thing to do over the long term. But they're doing it at a time when the RBA has been raising interest rates and when our economy has really troubling signs. I mean, the data yesterday in Australia was that services are in contraction and that the manufacturing sector hit a 14-month low. So that's not exactly the right economic environment for the RBA to be raising interest rates aggressively, and for the government having to chase the tail, if you like, and starting to wind back infrastructure spending and whatever else they may do to get the fiscal book balanced. I mean, the Excel spreadsheet's nice, it's good to have it balanced, but there's a real world out there where consumers and businesses are already struggling under higher food and energy prices. And yes, we may have seen the peak in those, but they're still much higher than they used to be. And they've got higher interest rates, growing mortgage stress, and now the government's going to reduce spending, which it certainly should be doing in the long run. But I'm just wondering if this is the budget to do that in.
All right, how is this going to work? Fiscal policy in tandem with monetary policy, of course, ahead of the RBA's next meeting.
Yeah, I think the RBA has shown some, I was surprised, they showed some intelligence, Andrew, at the last meeting. Well, they haven't done that for about 2-3 years, so that was really nice surprise. I think they do need to slow the rate hikes, even go on pause. And it suggests that internally they are debating and beginning to recognise the Australian economy isn't as healthy as they thought it was. They didn't think inflation would happen. They didn't think the global slowdown would come to Australia, but it is. But at least they're recognising those forces, and maybe they shouldn't just be single-mindedly attacking inflation, particularly when this inflation is supply-side driven, not demand-driven, because the Australian economy is clearly slowing. Property prices are falling, and mortgage rates are going up at the same time. That creates a very difficult situation for some homeowners and investors. And we've got services already in contraction. So why would you continue raising interest rates? But they may use the fact that the federal government's budget is very responsible to really bring to an end, for the moment, at least go on pause with rate hikes.